Gold and silver may be sending a signal that looks bullish. But what if the market is setting investors up for something completely different? Behind the recent move, several forces are colliding at once. Interest rates, the US dollar, Treasury markets, global debt, and the fragile financial system. And history shows that when these forces move together, precious metals can make a move that catches even experienced investors off guard. So is this breakout the beginning of something much bigger, or the final warning before another sharp reversal? Welcome to NEX Alert. If you value clear economic analysis, consider subscribing. And let us know where you're watching from today. There may be one signal in this market that changes the entire picture. Gold and silver, false alarm, risk, and opportunity. Overview, what you need to know. The recent strength in gold and silver has created a familiar question across financial markets. Is this the beginning of another major advance, or could investors be witnessing a false signal before the market changes direction? At first glance, the picture appears straightforward. Precious metals have recovered strongly from their recent lows, investor confidence has improved, and the broader macroeconomic environment continues to provide reasons for owning tangible assets. Yet markets rarely move in straight lines, particularly when several major forces are shifting at the same time. The important issue is not simply whether gold and silver are rising. The more important question is whether the forces behind that rise are strong enough to sustain it. That distinction matters because technical breakouts can sometimes create the appearance of certainty precisely when uncertainty is increasing. A resistance level can be broken, momentum can accelerate, and investors can begin positioning for substantially higher prices. But if the underlying economic conditions fail to confirm the move, the same breakout can quickly turn into a reversal. This is where the current precious metals market becomes particularly interesting. Gold is not moving in isolation. Its performance is connected to interest rate expectations. Treasury yields, the strength of the US dollar, inflation, government debt, central bank policy, and global liquidity. Silver adds another layer because it combines monetary characteristics with industrial demand. When these forces align, precious metals can experience powerful moves. When they conflict, even a seemingly strong rally can become vulnerable. Historical market cycles provide another reason for caution. During major financial disruptions, gold and silver do not always behave exactly as investors expect. A sudden market sell-off can initially pressure precious metals as investors search for liquidity and meet margin requirements elsewhere. That can create a temporary decline even when the longer-term environment remains favorable for hard assets. This creates the central dilemma. A correction does not necessarily invalidate a bullish cycle. At the same time, a rally does not automatically confirm that the next major leg higher has already begun. For investors, business owners, and entrepreneurs managing capital, that difference can be critical. The objective is not to predict every daily movement. It is to understand what the market is communicating before making decisions based on the headline price. The current setup therefore requires attention to more than the chart. The next clues may come from the Federal Reserve, the Treasury market, the US dollar, and the global financial system itself. If those forces begin moving in the same direction, the recent gold and silver rally could prove to be much more significant than it appears today. But if liquidity conditions suddenly tighten, the market could deliver one more painful test before the larger trend becomes clear. And that is why the apparent strength in gold and silver may not be the most important story unfolding right now. The real story may be what is happening underneath the surface, where monetary policy, debt, currencies, and financial stress are beginning to converge. The most dangerous mistake in this market would be to treat gold and silver as if they were simply reacting to investor sentiment. Their prices are responding to a much larger system, and that system is becoming increasingly difficult for policymakers to control. The first pressure point is the Federal Reserve. For months, financial markets have attempted to anticipate what the Fed will do next. Every employment report, inflation reading, and consumer spending figure can shift expectations within hours. A weaker economy can increase the probability of lower interest rates, while persistent inflation can force policymakers to remain restrictive. Gold sits directly in the middle of that conflict. When interest rates remain high, non-yielding assets face competition from bonds and cash. But when markets begin anticipating easier monetary policy, that competition can weaken. The opportunity cost of holding gold changes, and capital can begin moving toward assets that provide protection against currency debasement and financial instability. Yet there is a complication. The economy does not need to collapse for gold to remain attractive. A slowing economy combined with stubborn prices can create an uncomfortable environment where policymakers have fewer good choices. If economic growth weakens while inflation remains elevated, cutting rates aggressively becomes difficult. Keeping rates high, however, can increase pressure on businesses, consumers, government finances, and financial markets. That tension is becoming increasingly important. The United States is carrying an enormous debt burden, and higher interest rates make that burden more expensive to maintain. Every refinancing cycle can bring higher financing costs, creating additional pressure on government finances. For markets, the question eventually becomes less about whether debt exists and more about how the system will continue servicing it. This is where the Treasury market becomes critical. Government bonds are often treated as one of the safest places to store capital, but safety depends heavily on confidence, demand, and the price investors are willing to pay. If investors demand higher yields to hold long-duration government debt, borrowing costs rise across the financial system. That creates a feedback loop. Higher yields can increase financing costs. Higher financing costs can increase fiscal pressure. Greater fiscal pressure can raise concerns about future monetary policy, and those concerns can influence demand for the currency itself. Gold does not need a financial crisis to benefit from this environment. It only needs investors to question whether traditional safe assets provide the same protection they once did. Silver introduces another dimension. Unlike gold, silver is deeply connected to industrial activity. It is influenced by manufacturing, technology, energy infrastructure, and investment demand at the same time. That makes silver potentially more volatile, but it also means that a synchronized increase in monetary demand and industrial demand can produce an unusually powerful move. This is why the current market cannot be reduced to one Federal Reserve meeting or one inflation report. The larger question is whether monetary policy, government debt, Treasury yields, currency strength, and global liquidity are gradually creating an environment where precious metals become more important within portfolios. And there is one additional factor that could complicate the entire equation. What happens when the world's major financial markets begin losing confidence in the traditional definition of a safe haven? That question leads directly to the dollar, Japan, and the global flow of capital. There is a paradox developing inside the global financial system. The assets once considered the ultimate destinations during periods of uncertainty are beginning to face questions of their own. The US dollar remains the dominant reserve currency. US Treasuries remain central to global finance, and the Japanese yen has spent decades functioning as a source of inexpensive capital. But when the foundations underneath those assets begin shifting, the consequences can travel far beyond Tokyo or Washington. Japan is particularly important because its financial system has played a unique role in global markets. For years, extremely low Japanese interest rates encouraged investors and institutions to borrow cheaply in yen and deploy that capital into higher-yielding assets elsewhere. That structure created what became known as the yen carry trade. It worked remarkably well while Japanese borrowing costs remained low and global liquidity remained abundant. But the equation changes when Japanese rates and bond yields begin moving higher. Suddenly, capital that once appeared almost free is no longer free. That matters, because Japan is also a major holder of US government debt. If Japanese investors need to reposition capital, support their currency, or respond to changing domestic yields, the movement of money can influence treasury markets and global liquidity. This creates a chain reaction that is easy to underestimate. A shift in Japanese monetary policy can affect the yen. The yen can affect the carry trade. The carry trade can influence global risk assets. Changes in global risk appetite can affect treasury demand in the dollar, and when those markets begin moving together, precious metals can respond in ways that appear confusing if each market is examined separately. This is why the dollar deserves special attention. A weaker dollar generally makes dollar-priced commodities more attractive to international buyers. But the larger significance is psychological. If global investors begin questioning the purchasing power of major currencies, gold becomes more than a commodity. It becomes an alternative form of monetary protection. That does not mean the dollar is about to disappear from the global financial system. Such a conclusion would ignore the enormous size, liquidity, and institutional importance of U.S. financial markets. The more realistic question is whether the dollar's dominance can gradually coexist with a world where governments and central banks increasingly diversify their reserves. That distinction matters. A monetary system does not need to collapse for its structure to change. Central banks can accumulate gold. Countries can expand bilateral currency settlements. Investors can diversify reserves. Governments can reduce their dependence on a single financial system. None of these developments alone represents the end of the dollar. Together, however, they can change the marginal demand for dollars and traditional reserve assets. And this is where gold becomes particularly interesting. Gold carries no government's promise to repay it. It does not depend on the solvency of a corporation. It is not created by expanding a balance sheet. Its value can rise when confidence in traditional financial claims begins to weaken. Silver can benefit from the same monetary forces, but its industrial role makes its behavior more complex. The critical issue is therefore not whether the dollar suddenly collapses or whether Japan triggers an immediate global crisis. The real issue is whether the financial system is entering a period where the traditional safe haven hierarchy becomes less reliable. If that happens, capital will search for alternatives. And the next question becomes far more uncomfortable. What happens to gold and silver when the global market suddenly needs liquidity at the same moment that investors are beginning to question where that liquidity should come from? That is where the difference between a temporary metals correction and the beginning of a much larger monetary shift could become visible. The most important question now is not whether gold and silver can move higher. It is whether the forces supporting them are strong enough to survive the next period of market stress. That distinction separates a sustainable monetary trend from a temporary rally. There are two broad possibilities. The first is that the recent strength in precious metals represents the early stage of another major advance. In this scenario, technical resistance is gradually absorbed. The US dollar remains under pressure, expectations for easier monetary policy increase, and concerns surrounding government debt and Treasury markets continue to strengthen demand for tangible assets. If those conditions develop together, the recent move could eventually look less like a breakout and more like the beginning of a much larger repricing. The second possibility is more complicated. Markets could experience another liquidity shock. Equities could decline sharply. Investors could rush toward cash, reduce leverage, and sell positions simply to meet obligations. Under those circumstances, gold and silver could also experience a temporary decline. But that would not necessarily mean the long-term thesis had failed. In fact, history suggests that the initial reaction to a financial shock and the response that follows can be very different. During periods of forced liquidation, investors sell what they can sell. Once the immediate liquidity pressure passes, attention often returns to the underlying problems that caused the crisis in the first place. If those problems include excessive debt, currency debasement, weak confidence in government finances, or declining real purchasing power, precious metals can become increasingly important. This is why investors should be careful about confusing volatility with invalidation. A temporary decline in gold or silver does not automatically mean the monetary environment has changed. Likewise, a sudden rally does not guarantee that prices will continue higher without interruption. The more useful approach is to watch the system underneath the price. Federal Reserve policy remains one of the major variables. Treasury yields provide another important signal. The US dollar can reveal changing expectations about global liquidity. Japanese monetary policy can influence international capital flows. Inflation can determine how much purchasing power currencies lose over time. Together, these indicators provide a much clearer picture than any single price target. For business owners and entrepreneurs, this matters beyond an investment portfolio. Capital preservation becomes increasingly important when the economic environment becomes unpredictable. Businesses depend on purchasing power, financing costs, consumer demand, and access to credit. A major shift in interest rates or currency conditions can affect operating costs and investment decisions long before the consequences become obvious in the headlines. That is why the precious metals question should not be reduced to whether someone is bullish or bearish. The deeper issue is allocation. Gold and silver do not need to outperform every asset every year to serve a purpose. Their potential value lies in diversification and their ability to behave differently when confidence in financial assets weakens. But discipline remains essential. The greatest danger may not be buying too early or buying too late. It may be waiting forever for the perfect price. Markets rarely provide perfect entry points. Investors who constantly wait for one more correction can eventually discover that the correction they expected never arrived, while the larger trend continued without them. At the same time, disciplined positioning does not mean chasing every rally. It means understanding the environment, accepting uncertainty, managing exposure, and recognizing that short-term volatility can exist inside a much larger structural trend. That brings the analysis back to the original question. Is this a false alarm? Perhaps the market will deliver another correction. Perhaps gold and silver will temporarily lose momentum. Perhaps investors will receive one final opportunity to accumulate at lower prices. But there is another possibility. The apparent false alarm may actually be the warning itself. The charts may only be showing the visible surface of a much larger transformation involving debt, currencies, interest rates, global liquidity, and confidence in traditional safe assets. If those forces continue developing in the same direction, the next major move in gold and silver may not be defined by a single breakout. It may be defined by a change in how the financial system values protection itself. And when that change becomes obvious to everyone, the opportunity may already look very different from what it looks like today.